Some who study the international oil market believe there is no end in sight to the low oil prices that afflict producers today. They say that in 2016, the market will look a lot like it does right now, oversupplied with cheap petroleum products. Demand growth will remain low, and major producers will maintain high levels of output. And maybe they're right. But maybe demand growth is low and production is high simply because nothing has compelled producers to alter their behavior, at least not yet. After all, in the economy of the oil trade, as in all things geopolitical, time matters. And as time drags on, the geopolitical circumstances of the world's producers can change. In some places, change is already underway. Saudi Arabia, Kuwait, and other major OPEC producers have been waiting for U.S. oil production to fall, and fallen it has, from 9.6 million barrels per day in June to 9.1 million barrels per day in October, with further reductions in the offing. But even if their forbearance gives them the opportunity to coordinate a managed production decline and thus bring prices back up, it fails to consider that Iran could soon produce whatever oil the United States can't once it re-enters the market. In Russia, another notable oil producer, state finances are under duress due to low energy prices, Western sanctions, and additional military spending, all of which have forced the government to consider restructuring its tax schemes for energy companies. Those schemes could result in a 5 to 10% drop in production, albeit over the next few years. In Brazil, a scandal involving state-owned energy firm Petrobras has spread beyond the energy sector and now threatens to take down President Dilma Rousseff, whose coalition is crumbling as she faces the prospect of impeachment. Coupled with low oil prices, the scandal has forced Petrobras to dial back its ambitious plans to produce 4.2 million barrels per day by 2020. Its revised production targets, now at 2.4 million barrels per day, could be lowered even further. In Venezuela, the fiscal policies of the ruling United Socialist Party have created high levels of inflation, a huge disparity between official and unofficial currency exchange rates, and a shortage of staple goods. The party is splintering, and its control over the government is now in question. Political disruptions could easily lead to production disruptions in a country that sorely needs as much oil revenue as it can get right now. In our November issue of Compass, which comes out November 2nd, we explore in greater detail how geopolitics intersects with oil supply in each of these producers, and explain what kind of issues they will encounter in 2016.